Hi everyone, my name's Darryl Panes, CEO at As Good As Gold Australia. And today, once again, I'm joined by my brother Brian.
Thank you, Darryl.
Partner at As Good As Gold. And today we interview John Adams, Chief Economist at As Good As Gold Australia. Good afternoon, John.
Good afternoon, Darryl and Brian. How are you today?
Very well indeed, John. I'm sure today we're going to have a very keen talk on the budget and all the finances that are involved with that.
Yeah, well, look, I feel well, but I feel very concerned, Brian, as I'm sure John does, about the future of our children, and maybe their children, because they've been saddled with quite a debt after Josh Frydenberg, of course, announced the federal budget last week. And it seems that a lot of Australians aren't seriously concerned moving forward. Some of them feel quite comfortable with the budget. But here's the point, and this is the way I'm reading into it. You know, I have a son, you have two sons, and they're going to be saddled with the debt for a very long period of time. So there are serious ramifications attached to this budget. And Josh Frydenberg, of course, or John, I should say, has described Josh Frydenberg's budget as grounded in modern monetary theory, MMT, of course. And so I think a lot of people misunderstand or have no real comprehension of how MMT works. I think, based on the budget that we've just received and the serious ramifications from it, John should, and if you could, John, please explain to our viewing audience what MMT is, how does it work, and what could be the serious consequences of MMT right now?
Sure. Thanks for the question, Darryl. So probably the first point I want to make, Darryl, is that the key objective. So when we think about last week's federal budget, the budget was constructed with a sole purpose in mind, and that was to drive unemployment below 5%. Now, historically, governments in Australia have put economic policies together trying to boost employment and to drive unemployment down. But this is the first time that I can recall where a specific number has been selected. And where this ties into modern monetary theory, so one of the lead advocates in Australia is a professor from the University of Newcastle called Professor Bill Mitchell. And he has given numerous lectures talking about the problem of involuntary unemployment. So those who want a job who can't get a job. And effectively, he said in multiple lectures that involuntary unemployment is not an economic problem, it's a political problem. And that all we have to do is that the government that has the printing press just has to spend as much money as necessary to get those who are involuntary unemployed into a job. And basically you can run a budget deficit to finance whatever jobs that need to be created. And that is effectively what Frydenberg did last week. So now, probably a couple points to add there. The first question is, well, why did they select 5%? It's a very interesting question. The budget papers don't make it particularly clear. But what we do know is that the 5% came from initially the Reserve Bank of Australia, and then it was supported by the Federal Treasury. So in our interviews over the last few years, I've spoken at length about the household debt bubble and the foreign debt bubble that we have. And obviously this household debt bubble is the biggest in Australian history. And what can bring it apart is when households don't have enough income to service their debt obligations, particularly in terms of the interest costs, if there's an interest-only loan, as well as if there's principal repayments. So unemployment is the linchpin that can bring the household sector down with all of these mortgages. And COVID-19 was a really big disruptor in that fashion. and they had to implement a whole host of extraordinary measures, from, for example, suspending insolvency to bank repayment holidays to rent moratoriums and moratoriums on rental increases, and obviously extraordinary stimulus, JobKeeper, JobSeeker, etc. So I think that the focus on driving unemployment down, that's solely about getting as many people into work as possible so that they can generate enough income so that they can meet their debt servicing obligations. So I do think that that while we have seen in historical times governments advocate for low unemployment, the fact that that unemployment has been selected at a particular level, and that the government has made the decision to spend an enormous additional sum of money to make that unemployment level work, and for it to be realised. I mean, that is something new in terms of Australian history. Now, one of the dangers of modern monetary theory is that in the business that we're in the gold and silver bullion dealership business, our position, based on 5,000 years of economic history, is that when you have a fiat currency where you print extraordinary sums of it, over time it loses value up until the point that that currency loses, people lose confidence in that currency, and that currency collapses. And then if you have your wealth in that paper currency or that plastic currency or that digital currency, whether it's the Australian dollar, US dollar, etc., you basically lose your wealth through some sort of runaway inflation, hyperinflation event. The MMT crowd basically do not think that running perpetual deficits is a problem. They think that people like us who worry about sound government finances, we completely misunderstand the nature of government, how government works, and how government finance works. And someone like Professor Bill Mitchell, when the issue of hyperinflation has been brought up as, isn't this the ultimate outcome of modern monetary theory, he has given some very flimsy answers when he talks about, for example, Germany 1923 or Zimbabwe in 2008. And he effectively says that hyperinflation in those two situations was not a result of money printing. It was a result of a dramatic reduction in economic supply. And if you have less goods with the amount of money that you have, that's what pushes prices higher. Now, I've written at length about that. People can go to my personal website, adamseconomics.com. I have an article there that I wrote a number of years ago called The Madness of Modern Monetary Theory. I basically dispel any notion that hyperinflation is not resulting from excessive money printing. It absolutely is. And I've done a number of sort of subsequent shows since 2018 when I first wrote about this. So the ultimate danger and risk of modern monetary theory is that if there is no responsible management of the money supply and the currency, and there is no sound public finances, you are going to have a huge inflation problem, leading ultimately to some sort of currency crisis.
Yeah, well, I mean, John Maynard Keynes basically was the instigator of MMT, but he always referred to spending the money and devaluing the currency in the process. But once you had achieved a certain positive result, that the object then was to, at that point, was to stop spending, if I've read this correctly. But in the case of MMT here, it seems to be quite clear to me that there is no intention of stopping the spending spree. It's just all about creating work for people. But at the end of the day, John, if you're not employed in work that produces goods and services that can be sold, surely there is no increase in GDP. It's ineffective. So have I got this right or what? I mean, you could have 100% employment. But if you're not producing goods and services that are attractive to international buyers, then you have nothing. Am I right in my assumption?
From an economic point of view, there clearly is a difference between having a job and then having a job that creates wealth. And having a job that creates wealth is when you are in a productive business where you are producing goods and services that the market demands, and you're able to sell those goods and services at a particular profit. But where government just creates a job for the sake of creating a job, and that's actually not adding any value to society. Again, all you're doing by creating employment in that fashion is you're just destroying wealth.
Thank you for that. But I think also the other strong point is interest rates. And you can continue to some degree to add to the debt when you've got interest rates at 0% or in some cases negative. But at some point, and I don't think we're far away from this, at some point we're going to see, and there is already talk about in the United States about increasing interest rates. And that's when it really gets out of hand, isn't it? Because you've just said that you go from 0 to 1%, 2%, 3%, and that's enough for somebody who's carrying a big mortgage. That's for a company that has taken on excessive debt to progress through COVID. That's when it really starts to show. We wouldn't need any more than 1 or 2% increase in interest rates to, I think, absolutely destroy our economy. How say you?
So where I think interest rates is particularly sensitive is in the household sector. So particularly over the last 6 months, we've seen quite a few people in certain cities around the country where they have signed up to large 6-figure, 7-figure mortgages, particularly buying houses at very low variable interest rates. And we're talking around 2% in terms of mortgage variable interest rates. So if those interest rates were to go up and these people do have a variable mortgage, the repayments would start to climb quite aggressively. And even if you look at, for example, Martin North's from Digital Finance Analytics, his mortgage stress data, mortgage stress at the moment is at 41%. So there's a good chunk of the mortgage market where they are struggling to meet all of their cash flow obligations. So if rates start to, and that's 41% at record low interest rates. So if interest rates start to go higher, stress on a cash flow basis will go through the roof. And that's when you're going to start to see major issues with delinquencies as well as defaults.
Wow. John, I've certainly got a couple of questions I'd like to ask you. Before I do, and I usually do this, and Darryl recognises that I put in a bit of a story before I ask the questions. But what we've just been talking about, MMT, it's not part of my question, but I did think of it the other day. MMT, what does it really stand for? We all know modern monetary theory, but I have my own take on it, and it's called magical money tree. So, and that's what I really think it is. There's a magical money tree out there that we just pick the dollars from it and we spend them. Don't worry about the creativity of those dollars. Just pick the money and it will be okay. The other point I'd like to make is a story that I came across. Darryl and I actually came across it about 40 years ago when, we were in an engineering business. It was up and down, and we decided to do other things as well. And in those other things, it was we were selling product on a competitive nature, but we were only being paid by what we sold, and it was not wages. And a gentleman talked to us, and he gave the story. Darryl's mentioned it before, but he called it Tan's Taffel. Anybody that goes back 40 years may have heard the same story. But the Tan's Taffel story was, at the end of the day, there's a quote. There ain't no such thing as a free lunch. And you think about this, there is no free lunches out there. Somebody has to produce the goods to go into that sandwich, or the goods to go into that dinner or lunch. And so somebody has to put in energy. So why I'm saying this is because At the end of the day, you cannot print, as I see it, you cannot print money and expect to get energy from printing money, because if it takes no energy to print money, which it doesn't, press a button on the computer and you add a zero, right? So therefore, you do not get productivity, and it's the productivity of the nation, of the people, that gives them the best result. So, my first question, a lot of Australians would believe that the major increase in government spending and debt is related to the COVID-19 pandemic. You say the government's own numbers proves it is not. Can you elaborate on what is driving government spending? What is the impact on the government's annual deficits and gross debt?
The narrative of the budget is all about the pandemic. And funny enough, I was actually with my mother last night, and we were talking about a number of these issues, and she said, didn't they have to spend because of COVID-19? I said, Mum, it has nothing to do with COVID-19, and you can clearly just look at the numbers. So now, when so one of the exercises that I recently did was, and I'll have an article published on the As Good as Gold website, as well as my own website, in the next 24 hours or so. But one of the things I did was I looked at the spending that was committed in last year's budget for fiscal year 2021, which was published in October 2020. And then I looked at the budget that was released last week for fiscal year 21-22. And I looked at the same 4 financial years, so financial year 2021 through to 23-24, and I said, well, how much additional, or how has spending changed over these 4 financial years, when they released the budget last year in October versus what they released in terms of last week. And what we find is that for the current financial year, the government is on track to spend $16.6 billion less. But once we start from July of this year, 2021, through to June 2024, the government is going to be spending an extra $66.7 billion. Now, some of that money will, and when I say some, a fraction of that money, perhaps even less than $1 billion, will be tied to buying the vaccines for COVID-19 and to distribute those vaccines in next financial year. But the overwhelming majority of that money has nothing to do with COVID-19. It has everything to do with things like all of the big announcements that were made last week, from aged care to mental health to childcare to providing more money for clean energy and climate change, to more money for defence, more money for Indigenous affairs. And that's where the bulk of the spending has gone. Now, the spending, which is kind of, Brian, tied to my last answer to Darryl, is some of it is tied to driving unemployment to 5%, and that's what we said is the main economic goal of the budget. But a good chunk of this is also related to the upcoming federal election. And you could clearly see on budget night, as Frydenberg was giving his speech, he had a checklist of politically sensitive constituencies that he had to give money to make them happy. He just went through that checklist. So which are the groups that are giving him grief? So obviously, in terms of older Australians, and we had a recent Royal Commission into the aged care sector, so more money had to be provided around that. And obviously, cost of living, with all the inflationary pressures that we have been seeing, has had a huge impact on people in relation to childcare costs, etc. And then obviously you've got, the government has had a huge, big issue in terms of women's issues. So there was a number of women-related specific announcements that they were providing, and then obviously you go down the list of climate change, Indigenous affairs, and a whole host of other sort of areas where they are trying to provide more money to try to keep everyone happy. But kind of like what you said, Brian, when I was growing up in the 80s, I mean, I remember hearing here in New South Wales the saying, money doesn't grow on trees. Well, the unfortunate thing is that too many Australians have come to the view that money does grow on trees because there is no concern about this additional level of spending that has been incurred but in terms of the budget. Now, the other thing you asked me, Brian, was about in terms of the deficit. So what I can tell you is that for this financial year, the deficit is on track to be about $52 billion better off compared to what they thought last October. And as we go into next financial year, 21-22, the budget deficit is going to be better off by about $5 billion. But when we start to look at the subsequent two financial years, so 22-23, 23-24, those two financial years, the deficit is actually going to be worse, according to last week's budget, relative to what the government published last October, to the tune of $24 billion. So basically over the next, so from July last year through to June 2022, we are slightly better off relative to how bad we thought the budget will be. But then we're racking up an extra $24 billion of additional debt through these deficits that again has nothing to do with COVID-19 and has everything to do with all of these additional announcements. Now, what I should say also is that the government has a whole host of assumptions that they have built in. Some related to COVID-19, for example, a full vaccine rollout by the end of the year, no major outbreaks for COVID-19, and for international borders to reopen by mid-2022. And then they have some assumptions around economic activity. So they're assuming next financial year that consumption will actually grow quite aggressively compared to what has happened this financial year. And then when you look at non-mining investment, they're expecting that non-mining investment over the next 24 months is going to grow quite aggressively. And if consumption and non-mining investment is slower than what the government has forecast, well, then these deficits are going to be much worse than what they have presented in terms of the budget. So even as I was watching the coverage, I was on Tuesday night last week, I was watching the ABC, and even the 7:30 report talked about heroic assumptions. So there are a number of heroic assumptions in these budget papers. And again, rather than presenting some honest accounting of where we think the country is really at, these assumptions are now used as a political exercise to present, the best numbers possible so that they can fool the public and try to win the next election. So that's the unfortunate thing on that front. And obviously, the last part of your question was about gross debt. So as we look into by June 2024. We're looking at, I think, $1.134 trillion in terms of gross debt. And then we had some new numbers that were presented for June 2025. We're looking at $1.199 trillion. So effectively $1.2 trillion. And, one of the key differences, because Darryl mentioned John Maynard Keynes. Keynes did advocate that in good times, a government should run a surplus so that you can actually pay back some of this debt. Well, as we go forward over these next few financial years, there is no prospect of a budget surplus by the federal government, and most of the state and territory governments in Australia have no plan to balance the budget, and we are just racking up untold sums of debt with no appetite or prospect of balancing the books, let alone paying down the debt. And what that means in terms of my future, given that I'm relatively younger than you guys, and the future of my children, and my children are only 6 and 2, the long-term consequences are quite horrific.
You're talking away there, and I'm listening intently. And one thing that came to my mind before I go on to the second part of the second question is that, as far as I know, raising money or creating money comes from two areas, and that is taxing the public. That's number one. The more taxes they bring in, the more money they raise. Obviously, the public don't like that too much, and so the other method is borrowing money. Creating a deficit, far as I can see, is borrowing money and keep on borrowing money until they can't borrow anymore. So, which brings me to my point here in question 4 of mine. Can you elaborate what these assumptions are and what are the implications if these assumptions don't come true? Now, an assumption is all very well, right, because you believe you can work with the positive of an assumption. But if it doesn't come to life, where do we go from here? Can you answer that for me, John?
One of the things that I like in a previous answer, so I did touch on some of those assumptions, in terms of COVID-19, but also some of these other assumptions like consumption and non-mining investment. But the other key point that I just want to make, and this is sort of drawing on from an answer that I gave to Darryl earlier in the interview, is classical economics would dictate that if you want to get unemployment down low, kind of like you said, kind of like what you were saying before, you need to basically save, you need to invest, you need to create productive businesses that can generate a profit. And the more profitable the businesses are, the more people that they can employ, and then you can have a productive society. And that's how you maximize employment. And obviously, when we look at the last time we had unemployment below 5%, which was in 2006, 2007, I mean, the Howard government in particular had a strong program of structural microeconomic reform, particularly in the area of industrial relations when we had work choices. So when you are trying to create employment and drive unemployment down to a predetermined level, and you're just doing it by spending money and by printing money, well, when that printing and spending stops, well, what happens to unemployment? It naturally will go up because you actually haven't created enough productive businesses to keep these people employed in the private sector. And that is, I guess, one of the at the heart of what is wrong with these assumptions. Is that, okay, so just say the government's strategy works and they get unemployment down to 5% because of all this spending. And to be fair, I should say there are some tax cuts that are in the budget. So there are some personal income tax cuts and there is some tax relief for business. Although I think that those business tax relief is more of a temporary nature than permanent. But with all of that, with tax relief as well as with all the spending, if you got unemployment down to 5% or below 5% in order to sort of ensure that this household debt bubble can remain intact, well, if they start to cut back on the spending, what that will mean is that if the private sector hasn't picked up enough steam, that will mean that unemployment will start to go up. And as unemployment starts to go up, again, we get back to the heart of what's really at fault in this economy, which is households that are in too much debt. And that's when you're going to get problems around servicing these mortgages, these personal loans, these credit cards, etc. So when we look at these assumptions, the assumptions they have made, in essence, are not sustainable because the whole economic premise of what they're trying to achieve is so radical in terms of economics that one, it doesn't make sense. It doesn't make intuitive sense as to how do you grow wealth. You don't grow wealth by making money out of nothing and then go spending it. You create wealth by creating goods and services that the market demands and that you can make a profit from. So the fact that MMT and this whole budget strategy is basically let's print and spend and let's get unemployment down to some temporary level. Well, what happens when you can't print and spend anymore? What happens at that point? And the problem is that these budget assumptions haven't even come to that question. I mean, the government has presented these numbers in such a way that they have not allowed the public to critically assess their budget strategy. All they're saying is, we have plenty of money. We'll do anything to save the economy. We're great guys. And all you have to do is just vote us in at the next election, and everything's going to be okay. Well, in the real world, that is just complete fantasy.
As I said before, Darryl continues on. The way I see it is that we have presently, and probably for the last 30 years, we've had a group of government politicians that are very short-term thinkers, and they only think to the next election date for them to get re-elected. The way I see it, since we were off the gold standard, if their assumptions were positive and rosy, well, we wouldn't have a continued deficit. Sure, some years we may have a surplus, but if you have a look at our continual deficit, it keeps on rising. So obviously there's something gone astray in this area. Thanks, Darryl.
Look, I do get back to Vern Gowdy. I don't mention Vern a lot, even though I have enormous respect for him, but I make reference to this. He said, and he wrote the book, The End of Australia, there's only one way to go broke, and that's to have too much debt. Now, right now, Australia has, and the world has, an enormous amount of debt. But, trillions roll off the tongue. It doesn't matter whether it's 100 million, 100 billion, a trillion,
just a number.
28 trillion in the case of the United States of America. Brian's right, it's just a number. What I'd like you to share, John, is because when I finished my working career, and Brian the same, this is going to be left to our kids to pay. There is no way of avoiding this. There isn't anybody else out there to take on that role other than our children and maybe their children. The point I lead to is this. What I'd like you to do is share what you believe, and you'd have the numbers, I'm sure, based on debt we have at the moment. What sort of interest are we expected to be paying? Is our government expecting to pay? And the only way they'll generate that is from taxation, or printing more currency. They do have no other options. But what is the interest on the debt that we're expecting our government to pay over the next decade, say, for example?
Now, I don't have the numbers for the decade, but what I do have is that the budget papers provide the expected interest costs, and so obviously part of my criticism of the government has been how they have managed and responded to COVID-19. So when we look at just before the start of the pandemic in July of 2019, and if we go through to June 2025, so we're talking 6 financial years, the government is expected to pay $113 billion in interest over 6 years. And that is just roughly just shy of about $20 billion per year on average. So over these few years, I think in financial year 1920, I think the interest bill was about 17 billion. By financial year 23-24, the interest bill will be about 20 billion a year, and then in 24-25 it will be about $21 billion a year. So I mean, when we were debt free in terms of the federal government back in 2007, we had a lot more money that we could actually commit to a whole host of needy causes, because we didn't actually have to waste money on interest. And now we are wasting $20 billion a year, and $20 billion is a extraordinary sum of money if you think what you can do with $20 billion a year. But we just actually now have to just pay bondholders so that we can have the maintain the level of debt that we have. But one of the frightening things about this interest situation is the effective annual interest rate that the government is going to be paying, because what the budget papers assumes is that the interest rate is actually going to fall over the next few years. So in the current financial year, the effective interest rate is about 2%. As we go forward from July 2022 and beyond, the annual interest rate is assumed to be 1.8%. And so even though the interest bill per year is going up, it's going up by a small fraction because they are assuming that interest rates on government debt is going to come down. And just like with any household or government or corporate or corporation that has a lot of debt with a very low interest bill, if interest rates were to go up, the interest costs of the debt starts to skyrocket, and then your ability to service your debt becomes into question, and that's an issue of that's been an issue for governments and households and corporations going back to the beginning of time. And again, the government has not built in any contingency for rates to go up. And Darryl, I mean, you've been in business for a long time. No doubt in your career you've seen individuals and businesses who have poorly prepared for bad times, and when bad times do come, they get into all sorts of financial trouble because they basically just racked up debt and spent like drunken sailors in the good times, and they had nothing to fall back on when things turn pear-shaped. And I know you like to quote your mentor about being able to party every day, or able to party on every single night. But yeah, the thing is that at some point the music's going to stop, and then Australia as a collective nation, we won't be able to party at all.
If MMT worked, then there would be no need for you, John, to do what you do, no need for me to do what I do, Brian, no need for any of us to run a business, no need for any of us to work for anybody, because if it worked, all you would do is print more, increase your debt, but who cares? And if it worked, why have we been paying tax for so long? So it doesn't work. It never has worked over the long term. And in 5,000 years, John, and we've repeated this, I know, but it doesn't seem a better time than to do it again. But over 5,000 years, there's never been a fiat currency that's worked yet. There have been 3,800 of them. They have all failed every single time. So the expectation quite clearly is that this one's going to fail as well. So, and I don't think we've got long to wait. You know, we already know that currency's lost 98% of its value when compared to gold. So there's only 2% to go. And of course, unfortunately, that 2%, from 2% it goes to zero. They have no value at all left in the currency that you're holding. Not a good sign, and not a good sign for our kids moving forward.
No, not at all. John, let's summarise. We're going to summarise what we've said today. And so what are the key vulnerabilities and risks to the finances of the Australian government from last week's federal budget?
I mean, look, if you boil it down, you've got two key vulnerabilities, because what the government has tried to assume. So there was a really interesting quote in the Australian Financial Review, and the quote goes along the lines of, the government is trying to create enough growth that they can meet the interest bill over the next decade. So there is no prospect of paying down the debt. And according to the numbers that we can see, there is no prospect of balancing the budget. There is some hope of balancing the budget in 2030 or 2031, but who knows what's going to happen when we get to that point. So as we continue to rack up huge volumes of debt over the next few years, the two key vulnerabilities around the sustainability of this debt is one of two things. It's either if interest rates were to skyrocket, and interest rates, just so our audience is aware, interest rates is not just that the central bank raises interest rates. It could mean a number of different factors. It could mean that quantitative easing ends, and that happens, well, then interest rates on long-term bonds were to go up. It could mean that Australia has yield curve control on 3-year bonds. If that was to end, the interest rate on 3-year bonds would go up. It could mean that short-term rates with the Reserve Bank of Australia, that could go up. That could be a possibility. Or if we do have runaway inflation, bondholders will not hold the bonds at current interest rates, because they're going to demand a higher rate of interest as compensation for the higher rate of inflation. So if we have higher inflation, you're going to see bondholders sell government bonds quite sharply, and all of that will lead to high interest costs, and that will make the debt harder to service. So that's the key. That's the first key vulnerability. The other key vulnerability is if the economy is weaker than what is expected. So anytime you have a debt, whether again government, household, or corporate, your ability to service that debt is based on your ability to generate income to meet your cash flow obligations. And if economic growth is lower than what is expected, that's basically going to mean that the government is going to, on the one hand, because if economic growth is lower, by implication, one will assume that unemployment is going to be higher, and that will mean that with higher unemployment, there'll be more costs that the government will have to meet because of the social safety net that we have in this country. But also that will mean that we'll have lower tax revenue coming into the government coffers, and that will obviously make it harder for the government to service the debt. So, I think the two key vulnerabilities is lower economic growth than expected, or high interest costs. But also, I should say that when we think about the international context, we have an extraordinary amount of foreign debt, we have an extraordinary amount of household debt, and now we have this bulging public sector debt as well. We are highly geared to the world, and at some point, if the world says we don't think you're going to pay us back this money, which is in gross terms north of $2.5 trillion, we could see a balance of payments crisis, a currency crisis, if our foreign creditors say we're not confident in your ability to repay. We want you to start repaying more aggressively back, and that's when you start to see problems around the currency, when your international creditors say, well, I don't trust your commitments anymore. And to be honest, that's what's happened to Lebanon. So in 2019, the Lebanese government was, I think, the third most indebted government in the world relative to GDP, even though it's a small country, but relative to their size of the economy, they were number 3 in the world. And then last year, a whole host of creditors from Europe said to the Lebanese, we don't trust your promises that you're going to repay us with sound currency, because you keep on printing it to finance these deficits. And then the Lebanese pound went through the floor on the foreign exchange markets, and as a result, Lebanon has gone through a mini version of hyperinflation, not to the extremes of Germany, Zimbabwe, or Venezuela, but there's a lot of Lebanese immigrants who have settled here in Australia, and I know quite a few of them, and I've heard all sorts of horror stories of people not being able to eat in Lebanon because of how extreme the hyperinflation is. So again, when you borrow from the rest of the world, you're at their mercy, and that's exactly where Australia faces itself at the moment.
Yeah, that sum of 2.5 trillion, this is what it's all about. We might have a couple of surpluses, but the majority are deficits. And that obviously you don't create 2.5 trillion in deficit by not having any deficits. So it's the confidence in Australia to be able to pay back that debt, and I don't believe there is one. Darryl?
Mm-hmm. Now, look, not surprisingly, Brian, John, gold, silver, have advanced considerably over the last couple of weeks. Been relatively stable over the last 2 or 3 months, but the last couple of weeks, gold is up $100 an ounce, silver up $100 a kilo. You buy a kilo of silver today, it's going to cost you $100 more than it did 2 and a bit weeks ago. So no real surprises there. And cryptos haven't performed as well. In fact, they've experienced a bit of a dip. But once again, gold and silver are the safe haven investment. There will never be anything like gold and silver as a store of value, in particular in this environment. And so as there are inflation fears, and I see it everywhere with real estate, but I see it in food. I was at a restaurant the other night and I just couldn't believe how much it cost versus 6 months ago. And the dramatic increases. And a lot of that's been brought about by the fact that they can't find good people or enough good people, so they've got to pay them more. So the restaurant has to increase their prices to be able to afford that staff, just to be able to bring them on. So you can see all sorts of ramifications starting to take place here. But here's what's really interesting, and I know I've given this illustration before, but I was just sharing it with a new client the other day, and I shared it with an older client a few days before that, and they scratched their head and said, "Gee, Darryl, I've listened to you many times, but I didn't really hear you when you spoke about this previously. It just went over my head." But it's not complicated. This is what I want to share with people. If you had, and this is really interesting, I'm saying if you had $500,000 that you'd invested in precious metals, some people are going to say, well, that's a lot. And it is. It's a lot of money to invest in any particular market. But hundreds of thousands of people do it regularly in the real estate market. They'll not buy or purchase one property, but they'll purchase 10 properties at $500,000. So I'm saying full investment, $500,000. Let's look at what gold and silver have done. Let's look at gold for the moment, what it's done over the last 20 years. It's averaged in Aussie dollars just over 20% return each year, year on year. Pretty good result. So let's say that gold did exactly the same thing. Let's say for the next 5 years, you left your gold in the account. At $500,000, you've now got at 20% per annum, $1 million, approximately. Let's say that you at that point decide that you want to liquidate at the rate of growth, 20% per year. So you could withdraw liquidate $200,000 per year from your account without it ever affecting the balance. What a wonderful position to be in.
Fantastic example.
Now you can do that with any number you like. The return is phenomenal. And yet I was watching mainstream media last night and gold had gone up another $30 for the day and there was no mention of it at all. Right now, gold and silver are standout investments. And as a measure of protecting your wealth, even more so. Now I know that Brian's got an illustration because I want to draw a comparison here. That if you did invest in real estate, and let's say you had an investment property at $500,000, what could you expect for a return on that investment?
Yeah, like I certainly did my sums the other day, and I spoke to 2 real estate agents in the last week to verify the figures that I'm going to put to you. As Good as Gold Australia, our head office is in Adelaide, and Adelaide in South Australia, a bit of a sleepy hollow, but it's a good example of the return on investment. And in most cases, everywhere around Australia, real estate has gone up. And Darryl and I both agree, you don't have all your eggs in one basket. You don't have all your assets in one item. But there are such things called cycles. And the cycle for precious metals in particular are on the way up. But what I did is I had a look at an average person's investment, right? And most of them have got the real estate investments under their belt. So they invest in a residential home. In Adelaide now, what used to be a $375,000 average home is now $500,000. The last 3 years, it's just gone from everywhere around Australia, it's just gone berserk. So an average home in Australia, Adelaide, $500,000. The rent that they can claim on a $500,000 is around about $25,000 a year, all right? Or $500 a week, in simple terms. But there is also such a thing called on a house maintenance and costs, whether it be the cost of your council rates, the cost of refurbishing, the cost of maintaining, the plumbing, the electricity. All these are costs. So I discussed this with a real estate agent, and they said, "Yeah, you're about right. Around about 2 months out of 12 that you'll pay, right, some maintenance costs." So let's bring that down to from $25,000 a year to $21,000 a year, right? That's what you'll get with a $500,000 investment, $21,000 a year gross. So
versus $200,000 on the same figure if you invested 500, as we described earlier, $200,000, and you would never ever impact on the balance of the account.
Yeah, well, that's on $1 million. So that's exactly right. So what we're saying is that $1 million never goes down. The amount of gold goes down, but the gold goes up in price by 20% a year. So it just makes a lot of sense to have not all your eggs in one basket. You have some real estate, you have your gold, silver, and you might tinker around with something else. But while that cycle is about to go off with gold and silver, I guarantee you that's where the majority of your profitability will come from in the next 10 years.
That's where the great Russian czars, I mean, they have it beautifully set up. They've learned, haven't they? Gold, precious metals, land, fine art, and they can draw. They just continue to contribute to their already powerful position, and if at any point of time they decide that they need to liquidate, they do so.
Yeah, well, that's the other thing. You can liquidate any amount of gold and silver within 24 hours. I doubt whether you have the same success if you've got a $500,000 or $1 million worth of property.
It's another really good point, because gold, silver, Brian, you're 100% correct. I mean, you can liquidate, and people are amazed at how easy it is to access their funds with gold and silver. Property is a different matter. And just a matter of interest, I know that we've referred to $500,000 and $1 million here, but we could give illustrations, exactly the same illustrations, with much smaller numbers. So the average Venezuelan family, if they had an ounce of gold right now, they could buy 5 years of food. And what I'm suggesting is we are heading into uncharted waters, and we're not quite sure what it's going to be like coming out the other side, but precious metals are going to be an investment like none other that you could make. John, if you could, please, what I'd like you to do is share in closing comments your opinion on precious metals right now as a store of value and a protector of your wealth. Please, if you could.
Darryl, you said something really interesting that sort of caught my attention, which is when we get through the other side. Well, the way I look at these numbers, whether it's global debt or Australia's situation with household debt and foreign debt and public sector debt, there is no other side, because there is no resolution to this debt bubble. I mean, the only way we're going to ever get to the other side is we have to have enough people who are willing to shrink the debt. And shrinking the debt means going through the most painful depression in the history of Australia. And just for our audience, I know we've said this in the past, the 1892 depression in Melbourne in particular was the most horrendous depression in more than 200 years of Australian history, way more horrendous than the Great Depression of 1929. So it would have to be worse than 1892, and that devastated families for a whole generation. So the powers that be have said and believe that going through that sort of experience, even though that's in the national interest, and even though we're going to get through to the other side by having a more healthier economy with less debt, going through that process is too painful to even contemplate, and therefore we can't go through it. So what's the alternative? It's just printing more and more money. It's spending more money, and it's pushing propaganda to confuse the public. And so far, to a large degree, that has worked. But we know from economic history that these ideas and these approaches are completely unsustainable. The Australian dollar is losing value. So when we talk about maintaining wealth, well, again, if you bought an ounce of gold in, say, the year 2000 or 1999, you'd probably be paying around, roughly around 300 Australian dollars per ounce of gold. Well, now that 1 ounce of gold is worth about north of 2,400. So is gold worth more in more than 20 years of Australian history? Or is it that the Australian dollar has lost a lot of value over these last 20 years as we've wrapped up this massive debt bubble? Obviously the correct answer is that the dollar has lost value, and the dollar will continue to lose value under these policies. And I mean, for those who are sort of confused as to will the future hold inflation or deflation, well, these budget papers and the rhetoric from the Reserve Bank of Australia and the other central banks around the world, there is no prospect of deflation because they are not willing to deflate the bubble. So deflation only happens when you shrink the debt and when you deflate the bubble, and you have some sort of normalcy in terms of your economic affairs. And they don't want to do that. They just want to inflate by increasing the debt, printing more money, and basically just spending ad infinitum. So people need to wake up that this is not a game. I mean, look, I have to say, I read a comment I did a show the other day with Martin North, and someone basically said, well, the government's debt is the government's debt, but at least that doesn't impact me. Well, no, I mean, look, some people think that these conversations that we're having about government debt, it's some sort of video game, and it doesn't impact the average Australian. It absolutely impacts the average Australian because at the worst case scenario, if the government is desperate for money because they can't pay their debts and they're unwilling to default, well, what are they going to do? They're going to raise taxes. So you could raise taxes to take more of people's income, or you can start to do wealth taxes and basically outright confiscation. So for those people out there who have spent a lifetime building a set of assets in order to fund their retirement or to pass down to your children or grandchildren, if these government finances continue to get out of control, your own assets are at risk because governments historically, and you can go back through European history and look at English kings and French kings and all sorts of monarchs who basically started to confiscate people's wealth in order to service the debts of the kingdom. Well, that's the reality of where we're going. And in those sort of situations where exorbitant taxes and exorbitant money printing inflation do occur, gold and silver has been the one of the main avenues of maintaining wealth and maintaining some semblance of a decent life in the most extreme of extreme economic conditions. And that's why I started buying gold and silver starting in 2017, and that's where I decided to come and meet you guys in 2018 and be part of the team. And again, nothing in the last 3 years, as I've been with As Good as Gold, has changed my mind from where I was a number of years ago. If only my convictions around gold and silver have strengthened, purely because as we go forward, the madness coming from our elite economic policymakers continues to get worse by the day.
Yeah, so true, John. Now more than ever, I believe Jim Sinclair's principle of becoming your own central bank is so valid. And central banks all own gold, or tell us they own gold. And they own it to protect their position, gives them power and influence. And that's what you'll need in the environment that we're confronted with right now. And of course, Egon von Greyerz, who continues to say, when asked the question, how much should I invest in precious metals? And his simple answer is, whatever you cannot afford to lose. Very valid comment from a very smart man. John, thank you so much for your input today. Very appreciative. Once again, beautifully researched. We keep getting these comments coming back to us all the time after we interview John Adams. How knowledgeable is this man? And the answer is very knowledgeable. So thank you, John. Really appreciate your time, your input again today. And look, we'd like to thank our viewing audience, our viewers, and our subscribers. They support this channel on a weekly basis, continue to contribute. We appreciate that very much. And so until next time, can we suggest to you, stay well, stay focused, and goodbye for now.
Goodbye for now.